webinar. Thank you for your interest, especially in a day which I think a lot of interesting things are ongoing on the market, Greece related. So we appreciate your interest for a very fundamental topic of today's webinar. My name is Ralf Gleisberg from Akina, and again we appreciate the large interest our research has received, which we jointly did with Professor Oliver Gottschalk on the topic how to build an optimal private equity portfolio. I think the results of the underlying study, have been published in detail in a scientific working paper, which we could send you after the webinar if it is of interest for you. So who is Akina? I guess most of you know us already. Therefore, I want to just keep it short. Akina is an investment specialist who focused since 15 years on small and medium-sized private equity investments in Europe. While doing this, we have the largest team of investment specialists in the market exclusively focusing on this segment of Europe, small and medium-sized private equity in Europe. Who is Professor Oliver Gottschalk? He is a professor at the HEC Business School in Paris and a visiting lecturer at the London School of Economics and the New York University. But he's not only a leading academic who does research around the topic of private equity, he's also founder of his own firm Perax, which analyzes both returns and risk of private equity investments. So i.e. it's a perfect fit for today's topic. How did we find the topic of the research? I think we all know that it is how difficult it is today, or in today's environment of zero or even negative interest rates. And we see, on the other hand, increasing interest in the asset class private equity, which can still generate double-digit returns. I think private equity has experienced over the last 10 years an enormous growth with today many different investment opportunities. I think it's always good to have the choice, to have options where to invest, but it also increases the need for selection skills. I think even more as in the past, I think the formula of the past, yesterday's first quartile equals tomorrow's first quartile, does not seem to hold anymore. I think before an investor does the fund selection, he must decide more and more in principle, I think, on asset allocation questions regarding the build-up of his private equity portfolio. I think the starting point of our study has been a real investor who wanted to create a European private equity portfolio around the size of 200 million euro. Before starting, I think he needed to decide if he should focus rather on the small cap or the large cap segment. And I think in order to achieve a meaningful diversification, he proposed to invest the 200 million in five large buyout funds with approximately 40 million tickets each. However, in the small segment, he couldn't do this, so he couldn't repeat this. Why? Because it's already difficult to invest in general large ticket in small funds. But if you just want to invest into the best small funds, it is not possible anymore to systematically invest, for example, a 40 million ticket. Therefore, I think the direct comparison we ended up with in our study has been comparing a large cap portfolio of 5 large funds with a small cap portfolio of 15 funds. And I think with a 15 funds portfolio for 200 million, I think you end up with 10 to 15 million tickets, which is a rather reasonable size. I think here we both focus on, or want to focus on, return and risk aspects. And how did we do this? And on this scenario, but also other scenarios for this, I would like to hand over to Oliver Gottschalk.
Yes, thank you very much. So we've started to look at this question a good half year ago, and it's always fascinating to have research actually inspired from a real market need, from a real investor interest. But we thought we would broaden up the scope a little bit and see how we can shed some light more generally on the drivers of risk and return of private equity portfolios, based on a few of the very fundamental decisions into the design of those portfolios. So we didn't not only look at the aforementioned question of kind of the targeted fund size, but also looked at geography and the number of funds in the portfolio to then see how those very basic choices influence the expected performance, not only in terms of the average returns, but also of the return dispersion. And if you take a look at the next slide on the exact setup of this particular piece of research, we have leveraged performance information from Preqin on 771 sufficiently mature buyout funds, focusing on a vintage decade from 1998 to 2007, first and foremost because we wanted to exclude the still immature young funds in more recent vintage years that are still somewhat in the J-curve, as we didn't want to have that effect pollute our findings. Naturally, this is a vintage decade that was raised some time ago, but these funds continue to invest through the financial crisis, and we capture their cash flows and performance information until sometime about a year ago. So we don't only have dated information on before the crisis, but basically information that reflects also the very recent investment activity. This overall sample can then meaningfully subdivided along a variety of dimensions, not only based on the initial question of the size of the underlying funds that we cut in several branches and tranches, but also by the geographic focus of the funds, and then importantly of the selection ability of the fund manager, namely whether this fund manager is in the upper or lower median in terms of the performance. So are we talking about funds from the first and second best quartile, or from the two lower quartiles in terms of their rank in a given vintage year comparison? Based on these key characteristics of the underlying samples, we then applied the Monte Carlo simulation technique, which is really just a fancy word for rolling the dice very often, very systematically. And we've rolled the dice 1,000 times in every set of the simulation, drawing a given number of funds that we would then aggregate to 1,000 different portfolios from the starting sample. So we would either draw a single fund 1,000 times, or we would make 20 draws for 20 underlying funds, do so 1,000 times, and then always looking at the outcome in terms of the average performance of those 1, 5, 10, 20 underlying funds, but importantly also the return dispersion across the 1,000 possible outcomes to give a feel not only of the expected returns, but also for what may happen to you in the extreme cases, extremely good or extremely bad outcomes. Now, the first dimension that we looked at very importantly on the next slide is just the general question of portfolio diversification, because naturally if you increase the number of underlying funds in a given portfolio, you would expect some effect on the range of possible outcomes in terms of the performance. We see on the left chart here those bars reflecting the range between the best possible and the worst possible outcome of those 1,000 draws that we did, and then the dot in the middle, also the average portfolio return on those outcomes. On the horizontal axis, we just vary the number of underlying funds in the portfolio. And you see clearly if you draw only a single fund out of the 771 funds, you can basically end up with a total loss because the worst performing funds there didn't return any capital, or you end up with the best winner out of all those funds with a return multiple of 5.8 in the very extreme case. So a great range of outcomes if you only invest in one single fund. What you see clearly as we move to the right on that chart is that if you increase the number of underlying funds in the portfolio, you dramatically and fairly quickly reduce the range of possible outcomes. The average doesn't move much because, I mean, the average is the average of the sample. Whether you draw one fund 1,000 times or 20 funds 1,000 times from the same population, the average should only vary in the post decimals. But of course, the range of outcomes changes dramatically. Already looking at the diversification of 10 or 15 underlying funds, you can see it here that even the worst possible outcome in 1,000 cases is a positive outcome in absolute terms, so no capital losses across the worst of the 1,000 simulated portfolios. And in the best cases, you have a good performance in the range of maybe 2.4, 2.5x here, relatively stable in the cases of 10 or 15 underlying portfolios. So we see here immediately the strong risk-reducing effect of diversification, but also the fact that this effect has decreasing marginal returns as the change to go from 20 to 25 to 30 underlying funds here is minimal. Now we look at return dispersion not only based on that range that we have on those bars on the left-hand side here, we also apply a somewhat more novel and nuanced methodology that Parax has developed, namely a risk curve in which you show systematically the performance dispersion across that whole range of different outcomes. And that risk curve is basically calculated by sorting all the 1,000 possible outcomes from the least successful to the most successful, and then plotting cumulative returns of the worst 5, 10, 20% of all outcomes. So if you look at the darkest line here, the dark greenish line on the chart, it's initially downward sloping, which means that you have loss-making outcomes. If you draw from individual funds, it basically flattens out. The vertex is in the 10% area when you have all the 100 funds out of 1,000 scenarios that were drawn and that had a TVPI of less than 0. Then you bring in the marginal winners that generate to positive marginal positive additions and outcomes to the portfolio until you break even at roughly the 30% mark here. And then as you move to the right, you bring in the more and more successful funds until you reach 100% of aggregate value creation in the upper right-hand side. Simply speaking, the more curved, the more convex, the more exponential that curve looks, the more unevenly distributed the return outcomes are, the more this curve becomes flat and similar to that case of perfect uniformity, which corresponds to the diagonal in the middle, the lower the risk profile and the more uniform the outcomes. So also seen from this perspective, you see quickly that we find a quickly risk-reducing effect of diversification as we go from the single fund portfolio to 5 or 15 portfolios, whereas the shape of the curve becomes very similar between 15 and 20 underlying funds, documenting also from this perspective the marginal decreasing returns to additional diversification after about 15 or 20 underlying funds. Now, while these are important implications for the entire sample, we can then use the same methodology to gain insights for different subsegments of this overall sample. And the first dimension that we're interested in is to understand how the fund selection ability of the private equity investor will influence not only average returns, but also return dispersion. So on the chart here, you have different scenarios based on 5, 15, or 25 underlying funds in the portfolio, distinguishing between cases in which these portfolios were drawn from the upper or the lower half of the performance distribution. The red bars correspond to draws from the first and second quartile performance-wise, and the yellowish bar correspond to cases drawn from the lower 2 performance quartiles. Well, you didn't need any of this math to understand that the upper quartiles perform better than the lower quartile. But what's interesting to see is that in particular, as you add a healthy degree of diversification, like in the case of 15 underlying funds, the lower ends, the worst case outcome drawing from the upper quartile is dominantly better than the best case in the lower quartile. So that speaks to the important effect of fund selection, not only when it comes to average returns, but also as a means to reduce the performed dispersion. Interestingly, if you look at the cases of large portfolios, if you draw 15 or 25 underlying funds, even a worst case assumption, you're drawing from the worst half of the distribution, and you're looking at the worst possible case of 1,000 draws, the multiple there of 0.97 is still showing that you can be reasonably sure not to lose any money in absolute terms with a reasonably diversified approach in private equity, thanks to this diversification effect, which speaks to one of the attractive aspects of that asset class overall. Now, in addition to just the selection ability, we were keen to understand how the overall effect of diversification reveals itself in different geographic areas. You see here the aforementioned analysis replicated for 2 subsamples of this portfolio, either based on funds with European focus only or funds with North American focus only. Here we see, especially in the case of the small number of underlying funds, that yes, there's a higher return dispersion in European primary funds, but also the fact that the best performing portfolios are in Europe. In the US, you have a almost identical average, but a lower performance dispersion in the small portfolio sizes. But if you move to increasingly large portfolios, that basically converges, in particular in the important worst case scenarios where at 15 or 25 underlying funds in the portfolios, the numbers between North America and Europe become almost indistinguishable, whereas there continues to be a meaningful performance advantage on the best case scenario in the European private equity funds. So we looked at selection ability, we looked at geographic focus. Lastly, we of course want to approach the initial question that stimulated this research, namely the differences in risk and return dispersion of those simulated portfolios of different underlying sizes. Investors kind of know that the small and mid-cap and private equity can lead to potentially attractive returns, but at the same time we know that the performance dispersion, the interquartile range, is much larger on the lower end of the size spectrum. And this is exactly reflected here on the left-hand side when we're comparing small and mid-cap portfolios to large-cap portfolios of small number of underlying funds, of only 5 underlying funds each. The small cap here on the average has a higher expected return, 1.73 against 1.66, but also a substantially greater range of the outcomes, not so much on the downside, but importantly on the upside in the smaller mid-market. As we increase in our simulation the portfolio size, the number of underlying funds, we see again a conversion of performance outcomes, substantially reducing the range of outcomes on the small and mid-market in particular, where basically that segment of the universe benefits importantly from the diversifying effect of having larger portfolio sizes, which seems to over proportionally risk mitigate the performance dispersion here in the small and mid-cap segment. Now with this, we basically have the equipment to revisit the initial question, the very practical question on the next slide of an investor who was facing the challenge on where to allocate funds, where to commit when the objective is to place roughly 200 million euros in the European market. And in a simplified way of thinking here, the choice is basically then between a portfolio of about a handful of large cap funds versus roughly 15 small or medium-sized buyout funds. Comparing exactly those two cases within our simulation, we see an interesting dominance, a dominantly superior result for the more broadly diversified small and mid-cap portfolio compared to the large cap portfolio with a lower degree of diversification. You see it on the left-hand side here where, as we've seen before, the average performance is higher for the small and mid-cap funds, but it's not only the average performance that's higher, it's also a lower performance dispersion, or more importantly, a dominantly better outcome along the entire range of scenarios. So the best case of the more diversified small and mid-cap is better than the best case in the less diversified large cap. At the same time, the worst case of the more diversified small and mid-cap beats the comparable worst case in the 5 large cap funds. So it seems to be that a well-diversified small and mid-cap portfolio is indeed superior, and you see the superiority on the risk mitigation side also in the PERAX risk curve, where again the more diversified small cap portfolio, the red line here along the entire range of outcomes, lies within the range of the curve, of the grayish curve there on the right-hand side of the chart, and that's translated then also in a meaningfully lower PERAX risk coefficient, documenting the greater level of homogeneity of outcomes in the more diversified small and mid-cap segment. Here, of course, we want to make sure that this is not just something that's applicable in some parts of the world, so we were replicating this in different scenarios, both assuming selection skill of the investing limited partner and also then looked at different geographic regions. To start off with selection skills here, we see that if we assume a good selection ability of the GP, i.e. an LP selecting only GPs from the upper half of the performance spectrum, we see of course overall higher numbers in both cases, but we see the same dominance of the approach to invest in a more diversified fashion in the smaller mid-market. The average outcome is meaningfully higher, and also the extremes, best case and worst case, are dominantly better. The PERAX risk curves are almost indistinguishable in this setting. You can still see it a little bit in the risk coefficient, but at same or slightly better risk characteristics, the smaller mid-cap strategy has to a substantial outperformance over the less diversified large-cap segment. Largely, as I said, we looked at this in different geographies. We're not going to show you all the charts, but we just give you the focus for Europe here, where again we replicate the same analyses, both for investors who randomly draw funds from all different performance quartiles, or who are able to target effectively only the upper half of the performance spectrum, so the best two quartiles. We see very similar results than we've seen for the overall sample. That confirm that also in Europe apparently there's this dominance of the more diversified small and mid-cap portfolios over the less diversified large-cap portfolios. So with this, we can kind of revisit the original research question and draw some conclusions from the analyses. I think we've seen very strong evidence for the overall risk-reducing effect of diversification, but we also see that this this effect has rapidly decreasing marginal returns, so we can identify a sweet spot in terms of underlying funds of like 15 or 20 funds that can be considered sufficient. Of course, we see the positive effect of fund selection, of finding effectively the better fund managers, not only the positive effect on average returns, but also on return dispersion. And then there's this notion that the smaller mid-cap funds consistently outperform across different geographies. But importantly, that if you assume a sufficiently diversified smaller mid-caps portfolio and return its compared returns to the more concentrated large-cap portfolio, we find a dominant superiority of the smaller mid-cap approach, not only with respect to higher returns, but also to a more attractive risk profile. And with this, I'll hand it back to Dr. Gleisberg, who's going to wrap this up and put this a bit into practical context of an actual private equity investor.
Thank you very much, Oliver, for those interesting results. I think especially the results on diversification, I think are quite intuitive and in a way confirming what the portfolio theory of Markowitz has already resulted, I think, decades ago. But I think even more interesting, I think, is the effect of selection as you presented it, which make it even stronger, the results, not just on returns, but also on risk. So now the question, how do we implement those findings in reality, or how could an investor implement that? I think it is, everybody wants to have, I guess, superior selection skills, but I think it's fair to assume that a market specialist should have those skills. And I think that's what, at least in our case, like Kina, what we also get from external sources confirmed. So if we build our portfolios, I think ideally we are focusing on two types of investments. On the one hand, we would like to invest into the so-called hidden pearls. I think we discover new managers which are less visible to the outside, but those have typically the higher return, but also higher risk profile. So to balance that, we build the portfolio and invest into the second pillar, which are the best funds, which are very visible normally in the market, whatever best means. But as they are very visible, I think normally everybody wants to invest in such funds. So I think here it gets in the end not just important to deselect those who have been good in the past but are not good anymore in the future, but also to getting access to those funds as they tend to be very oversubscribed. Another aspect which we did not include in our study has been the cost aspect. So the cost to build such a portfolio. And we're not talking only on the costs of building the portfolio, of selection, of due diligence, etc., but it's also the costs to monitor such a portfolio. I think there's an easy correlation. I think the more funds you have in your portfolio, the more resources you need to manage it. And I think these costs could be either direct. I think if you do it on your own, if you have your salary, etc., so direct costs. But you could also outsource it, obviously, to an external provider, someone, for example, like a Kina. And in this case, you have indirect costs. I think this cost function, especially if you do it directly, I think look probably like a step. So it's a step function. Why? I think at a certain stage, you cannot handle it anymore, the workload with an increasing portfolio. So I think you probably would need to hire a second person or an additional person. On the indirect side, I think this is probably more a smoothly growing curve. But obviously, I think any fair comparison should be between those direct costs and indirect costs if you look at this aspect. With this, we would like to finish the official part of our webinar and would like to open the floor to the audience if any of you have a question to Professor Gottschalk. If you have a question, then press again the mute or the demute button. Maybe if this is not the case, I could play the icebreaker with one question. How do you think, Oliver, how if you compare the small and the large cap PE funds and looking at the value drivers, so how are they different, or are they different, and why are they different?
Yes, I mean this is of course a natural question that follows the overall result of the study. Clearly, we didn't have sufficiently granular data to be able to dig into this in the context of this research, but clearly if you talk to fund managers, the value creation levers are very different in the small versus the large end of the spectrum. You have much more room for improvement in the small area, basically allowing you to generate extreme outcomes, to go on to multiply your capital by 5, 10 in the extremely successful cases. They're much more difficult to do in $1 billion investment, to find so much room for improvement. Along the same lines, the big companies are just more resistant, more stable, so you'll also probably avoid the more extreme outcomes on the downside. And fundamentally, this is of course what is underlying these findings, which is driving the effect that we observe at the small and mid-cap spectrum, a greater performance dispersion, a greater dispersion of outcomes also at the fund level.
Okay. Anyone else having a question?
I have a question, actually. I wonder if you can hear me?
Yes, we can.
Oh, wonderful, wonderful. This is Adam Lay from PEI in London. Oliver, very interesting presentation. I wonder if you could talk a little bit about the role of secondaries, perhaps in your model, and also, I suppose, to a large extent, using secondaries to build the optimal portfolio.
Very interesting question, but a question that is a bit outside the scope of this particular study. As you may be aware, I've done some other work on secondary fund investments to understand the risk and return drivers there. We haven't looked at them in any systematic fashion here. Secondaries, of course, have possibly interesting features that can be advantageous to add to portfolio, not only to mitigate the J curves, but also to just balance out the return outcomes to some extent. In this particular study, we've been narrow in focus and focusing this on the primary fund investments only. But one of the things I like of being in private equity, there's no scarcity of good research questions. So I hope that this will keep me still busy for some time. And once we get to mixing them both together, we'll certainly be back with the next webinar and share those results with you.
Very good. I look forward to it. Thank you.
Are there any other questions? If this is not the case, I think we conclude with here, and I thank you very much again for your interest. And again, if you are interested to receive the full research, don't hesitate to contact us, and then we will send you the working paper. Thank you very much, and have a good afternoon. Bye-bye.
Excellent. Thank you, everybody. Bye-bye now.